Quarterly earnings are out for Conagra Brands, ticker symbol CAG. So let's do a top-down analysis. We are now sitting at a market cap of 15 billion, a PE of 17, and a dividend yield of 4%. However, due to the current macroeconomic challenges globally, Conagra have been battling COGS inflation, which is now up to about 16% and has really affected their business and margins, and is part of the reason why the stock is exactly where it was 5 years ago. The good news is they're now transitioning and seeing strong growth in their plant-based product segments, which has been a positive impact on fundamentals. So it begs the question, is this a worthy addition to our portfolios, assuming the fundamentals are intact, or should we leave this for hedge funds? Stick around to find out, as we're talking about that and more in today's episode. How's it going? Welcome to Everything Investing. Hope you're having a great day. Today we're going to analyze Conagra's business and earnings results. We'll start with an analysis into the financials. We'll go through the top line, the bottom line, balance sheet, cash flows, etc. And finally, we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether Conagra is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we'll be doing this analysis in 5 minutes, so let's jump into it. All right, and if we look at the comments from the CEO, they basically just mentioned that due to their strong brands, they were able to execute as expected in Q1 of fiscal year 2023. They continue to deliver improved service and productivity, obviously as they're navigating inflationary pressures and supply chain challenges, and that they reaffirmed their confidence in their outlook and guidance that they posted earlier for fiscal 2023, and that they remain focused on generating value for their shareholders. Okay, so they've talked about their brands. What kind of brands do they actually have? As you can see here, they have all different types of segments here, from frozen refrigerated meals to snacks to, canned goods, etc. And you'll probably recognize a lot of these brands as is, which are all inclusive to their portfolio. But how have these brands contributed to their long-term performance? As you can see, they've been able to generate about 12 billion in revenue across the board. They did have a slight slowdown here from 2015 to 2017, let's call it. But in terms of their top line, they have been able to produce about 12 billion consistently in sales. Now, how does that translate to the bottom line? Not very well. Their margins are very thin, as you can see here, and they've just managed to stay profitable here with a few years of negative profits. When we look at this from the cash and debt perspective, we are going to get into this in just a second because we're going to go through the balance sheet. But as you can see here, the debt here has been insurmountable when it comes to the cash figures, and that is what investors probably do not like at all. I know it's not something that I love, but before we speak more on this, let's actually jump into our income statement here. Okay, and starting off with our revenues here, of course, they brought in about $3 billion in revenues for this quarter. That is up about 10% year over year, so that is a great thing to see for investors. However, in order to produce that revenue, it cost them $2.1 billion. That is up 10%. They also tacked on a 140% increase in their SG&A expenses. So when we add this all up and we get to our operating profit here, you can see they actually came out with an operating loss here of $112 million. Last year, we were up 285 million. So we're definitely trending in the wrong direction there. And then when we get down to our net income figure, yeah, it's going to be negative $77 million here. Earnings per share came in at negative 16 cents. And now you might be wondering, well, from what the CEO said, it sounded like they had a good quarter. And that's because Conagra is focused on their sales. They're not as concerned with their profits. They feel that over the long run, they will be able to become consistently profitable, and that without huge gains in their SG&A expenses and such, we would actually see a nice profitable quarter. So I can understand where they're coming from a little bit. Do I love it? No. And then when we get over to their gross margins here, they have historically tried to keep it in and around this 25% figure. Obviously, that is declining right now, and especially over the last few years. So we want to see that actually trend in the other direction, and I would like to see how that progresses over this fiscal 2023. Now, if we jump into their balance sheet here, we can see they have cash and cash equivalents here, $67 million, and total current assets here of $3.2 billion. Now, this is primarily comprised of their inventories, so keep note of that. And the same thing with their total assets here of $22 billion, and a majority of it is made up of goodwill and brands and trademarks, so intangible assets, which means these numbers can easily be fabricated or misconstrued in some ways. Okay, let's jump down to their debt figures. They have notes payable, current installments of long-term debt, and long-term debt as well, which makes up a figure of about $9 billion on the $67 million in cash that they have. Yeah, that doesn't look too great. And it's the reason why, as you saw earlier, their cash position is definitely outweighed by the massive amount of debt that they do have in order to keep this business functioning. Again, not something a lot of investors will like. As you will see here on this slide here, their net leverage ratio is about 4 times. Typically, you'd want to see businesses with less than 3 times because that means that within 3 years, they could pay off all their debts. So again, something else I don't really like about Conagra here. And then when we get over to their free cash flow metrics, we have net cash flow from operating operating activities of $264 million. Deduct our capex expense here, and we're left with free cash flow of $138 million to reward shareholders. How do they do that? Well, instead of paying down that large amount of debt that they do have, they're paying out a dividend and they're also repurchasing shares, which ultimately means they're going to have to take on more debt to reward their shareholders. Not something I love as well. So overall, from what I can see so far from Conagra, I am not loving this business and the fundamentals. Finally, let's jump into our analyst expectations here for the end of fiscal year 2023. As you can see here across the board, analysts are expecting that they're going to have about $2.40, let's call it, in earnings per share by the end of the year, despite having a slow first quarter. So let's use this figure in our calculator to see at what price point we would be comfortable with picking up shares of Conagra for at a margin of safety. All right, so now jumping back into our calculator here, if we assume that for the first 5 years on an average basis they can stick with their 8% 5-year EPS growth metrics, then for the 5 years after that slows down to about 4% on a 17 PE, which is what they're currently sitting at. We could say that this business is valued at about $50 per share. Now, in the best case scenario, let's say this business can grow at about 12%, then 6% for the next 5 to 10 years on a 20 PE. Yeah, the stock would be worth about $70 per share. Right now we are sitting at $32 per share, so we'd be looking at more than a double in the very best case scenario. But in the worst case scenario, 3% growth for the next 5 to 10 years on a 10 PE, we'd be looking at $30 per share, which means, yeah, we're technically kind of sitting at a margin of safety standpoint here for Conagra Brands, assuming the worst case scenario with an economic slowdown. They are sitting at a price to sales ratio of about 1.4, a price to book ratio of 1.8. The price to free cash flow metric does not look amazing, and that is simply because of their bottom line that is being dragged down by all of their expenses. Again, they do have a mountainous pile of debt that they do need to clean up as well. So I would deduct a few points from these estimations, probably at least $10 per share from these intrinsic value calculations here in order to accommodate for the debt. So that is the analysis for Conagra Brands here. Please do your own research and due diligence. This is just my own opinion and research. With Conagra right now, we are kind of trending in between $30 and $35 per share, and they're kind of just bouncing back and forth. If we decide to head lower, we will see some support down here towards this $25 per share level. And if we head higher, we will take out these $38, $40 levels here. But again, that's all for today's video. Please like if you enjoyed the video, subscribe, and I'll catch you on the next one.